ability to be a detailed person in terms of what I need to do to educate myself has allowed me to get where I am everywhere in terms of everything, whether it's in my medical profession, in my real estate investing world. I think it's important to take your education very seriously, focus on it, spend the appropriate time, and then be detailed at what you do with that. And that's probably something that personally, I'm not sure if that's sort of allowed in terms of the way they answer it, but personally, it's most important to me from that standpoint.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Sam Giordano is a physician based out of New Jersey. Sam, welcome to the show.
Thanks for having me, Sam. I appreciate it. This is the first time I've ever had an interview with another Sam. So, so right away we have something in common. So that's great. Thank you for having me.
Absolutely, man. This is fun. Thanks for coming on. I know it's early for you. It's certainly earlier even for me. And that's one of the things we can talk about today is just kind of what it takes to get things done in the real estate space, especially when you're a full-time practicing physician. I know I've had a few others come on and it's 5 a.m. for them and they're just finishing up a shift. But, before we get into all that, the same three questions I ask every guest who comes on the show. In 90 seconds or less, can you tell us, where did you start? Where are you now? And how did you get there?
Yeah, no, thanks for the opportunity and thanks for having me on, Sam. I've really gotten a lot of valuable information from previous guests, and hopefully I can provide some of that myself. And thanks for having me. Yeah, so my name's Sam Giordano. As you said, I'm a practicing gastroenterologist in New Jersey. I've been practicing about 10 years now, and I had gone through the traditional personal finance sort of continuums that one does as a newly graduating physician about 10 years ago, trying to pay off student loans, contribute to my children's 529s. And then once you get enough capital, then you maybe have the opportunity to max out your retirement accounts and then invest in sort of taxable brokerage accounts. But up until that point, most of my investing had been through the equities or the stock market, sort of the traditional path. And then I would say about 3 or 4 years ago, I was sort of enlightened to some opportunities in real estate and how it can benefit high income professionals from a tax standpoint. So I started to do some due diligence on the different methods, whether it be investing through real estate, turnkey opportunities, active involvement in real estate. And I very quickly realized I didn't want to be getting the nighttime calls about, leaky faucets and broken toilets and things like that, just because I'm a full-time physician. My wife's a full-time physician. And so we were made aware of investing in real estate syndications, like I said, about 4 years ago. And it just opened up this sort of rabbit hole for me to where I've kind of dove right in, spent a full year kind of investigating things. And now since then, I've now been in over 12 deals over the last 4 years. So it's been a part of my investment thesis now. And I try to allocate a certain amount of my investable assets to it. And it's definitely made a difference in my life. And I think it could make a difference in others as well.
Yeah, absolutely. And it's amazing. And this goes for, and I've said this on the show many times, but this goes for military professionals. This goes for high income earners and really across the board. But especially I see in those two groups, a lack of financial education, even in the physician space. You get out and it's like, wow, these are really smart people. You guys are way smarter than I sucked at school, right? And you get out of school and it's like, oh, wait, there was never this, like, just the basic knowledge on how to invest across, non-traditional assets. It's like, wow, why is this so not taught in school?
Yeah, you're absolutely right. It's a big issue. And I work at a hospital that has about 700 physicians. We train residents, we train fellows. So even prior to investing in syndications, I do some education with the fellows that I train. And instead of doing my traditional gastroenterology lectures, on demand, they basically want me to do some of the personal finance stuff. So I try to make a difference in that. But you're right. There's definitely a lack of opportunities for them to learn personal finance. So we try to bring it in because it's not like it takes that much knowledge or information to make a huge difference from that standpoint. So we try to make a difference in that as well. But you're right. There's a lack of that, no doubt.
Yeah. What was the scenario when you use the words enlightened and made aware? What was that scenario about 4 years ago when someone kind of brought this idea across your desk?
Yeah, so I really around 2017 when with the Tax Cuts and Jobs Act was enacted, as somebody who lives in New Jersey, I really got hit pretty hard as a two-physician family with the tax implications when I couldn't deduct my state and local income taxes anymore. And so we had been sort of a traditional expectation of what our taxes would be on an annual basis. And then that following year, I probably should have thought about some tax planning, but that following year, I was like, holy cow, I can't believe we have this huge tax bill that we got to kind of write a check for. And even my wife and I are both W-2 employees. And even though we were happy in our jobs and we didn't want to really diversify out of that sort of W-2 situation, I wanted to look for ways that I can sort of at least come up with a second sort of income stream that's more tax advantaged. And that's when I started to come up on the real estate investing. And so a friend of mine had invested in real estate syndications and was trying to, give me some information on the tax advantages. And even though, if you're not a real estate professional, you may not be able to offset your actual income, but you can definitely offset some of the cash flow from the syndications. Right. And then there's sort of methods that you can do to sort of passive pairing sort of effect that you can then invest in subsequent syndications when a syndication is concluding that year and try to offset any of the capital gains and some of the depreciation recapture. So it just opened my eyes. I read as many books as I could, as many podcasts as I could, and then I got comfortable with finally investing. And then since then, it's been great. So I think hearing about the opportunity to invest in the real estate syndications and then learning about the tax advantages was just like I guess it opened a whole new world for me.
That's absolutely fantastic, and I love the the kind of on ramp, if you will, for you. I mean, it took an entire year of educating yourself and saying, and for those of you who are raising money, myself included, that's something we just need to keep in mind, is that it takes time to educate our investors. Yeah, just get them comfortable with this idea. I mean, I know it took even my own family a while to be like, okay, watch me. They're like, oh, okay, cool. I like what you're doing there. Tell me about what you guys are doing on that front on passiveadvantage.com.
Yeah, so basically, as I had said, I work at a hospital that has over 700 physicians, and I had, being someone who's involved in the teaching of the personal finance and when I started to get into the real estate, it started to come up in more casual conversations, in particular over the last couple years. Like for the first couple years of my investing, I was kind of doing it just for myself. And then for the last couple years, with the impact of COVID on physician burnout and more physicians kind of thinking about cutting down, either cutting out altogether and retiring, or just cutting back to maybe a 4-day work week or a 3-day work week, real estate started to come up in more and more of the casual conversations I had with these physicians. And I would point them to certain podcasts, certain books that I liked, maybe some real estate forums, but it kept having, I kept having the same conversation over and over with them. And then eventually, I brought up the sort of a tool that I've put together at the time for myself when a real estate syndication comes through my email, what I use to kind of look and see if there's any obvious red flag or risk points in the deal, that if none of it, if it checks all the boxes the appropriate way, then I move on to a further deep dive into that deal. And so a number of people wanted to have access with that, which I have no problem sharing, but the difficulty is I wasn't 100% if I'm going to share it with other people, I wanted to make sure it was tidied up and dotting I's and crossing T's. So then I partnered with my current partner, who is sort of an Excel spreadsheet whiz and someone who vets deals for syndicators or pre-vets deals. Mm-hmm. And we sort of combined to form a syndication vetting sheet that allows you to kind of see some of the risk points. And then that product then parlayed into a business that we have, with our website's passiveadvantage.com, where our focus is educating investors and helping people be aware of some of the things to look for and some of the risk points when looking at real estate syndications.
That's really cool. So just so I understand a little bit more clearly, like you kind of have a a secondary spreadsheet. I know for me, when I invest as a passive investor, because I do that as well, obviously
Yeah,
because there's just too many good opportunities, and I want to participate with my friends as well in those deals. But
sure.
you have a secondary Excel sheet that you guys have created that then, and I always get their Excel sheet because I want to see their underwriting. But then you'll take
Sure.
that and plug it into your own proprietary Excel sheet, and then kind of spit out a whole different set of numbers. Is that what I'm
That's
hearing?
right. Yeah, that's right. And the way the sheet is organized in that it's basically it's organized for ease of use. So you input some of the data on one particular page. So we call it the key metrics page. And then it sort of pre-populates into the rest of the sheet. So, and then when we do look at specific deal metrics, a lot of it is drop down based. So you don't have to go in and worry that a formula is not working or this isn't working. And then when a metric is outside of the range of normal, then it either highlights the cell red or green or yellow, depending on what the desirability of that particular metric is. For example, like an exit cap or rent growth rate or something like that. It may then highlight that this should be something you may want to ask the sponsor about. So we use the metrics that we get from the investment summary or any materials we get from the sponsor, and then input that into our sheet and kind of go from there.
That's fantastic. What a heck of a resource for passive investors. That's really cool that you guys are sharing that with your group there. Talk to me about financial independence. I mean, I'm gonna make an argument here and see if you can support or what's the other word I'm looking for there? Anyway, find the holes in my argument.
Deny. Yeah.
Yeah, support or deny it. Say, hey man, this isn't right. Because I also am
Yeah.
a passive investor in a lot of deals, but it's not enough, especially on a cash flow basis, to really offset my, working. I'm gonna call this my working income, right? Which
Sure.
is for me going out and actively doing deals, and I would say the same for you. Even with 12 investments, it's not going to really change or offset your income. So
Yeah.
what does that look like for you when you use that word financial independence? Obviously, a lot of these deals you get a big payday upon disposition, and that helps.
Yeah.
But
Sure.
in the interim, it's not an independence game per se as a passive investor. Am I wrong on that?
No, that's 100% right. I think so when you look at financial independence in the traditional sense, a lot of the personal finance blogs look at what's called the Trinity study, where they look at you have to save X amount, and if you use sort of the 4% rule, meaning that if your goal is to have, say, $100,000 in passive income when you retire, you then have to save 25 times that to get to a 4% withdrawal rate. So then you would need to save 2.5 million to get to that point before you can retire on 100,000 annually, roughly, if you want to assume that retirement will last a period of like 30 years based on that Trinity study. So that's sort of the holy grail of how financial independence or retirement appropriateness is looked at in the personal finance world. So the advantage of incorporating the real estate syndications is that instead of using that 4% rule, if you have, just assuming what sort of syndications on average give from a cash flow standpoint these days, when you take into consideration both the cash flow and the disposition amount, say you conservatively do that as 8%.
Right.
So now you have maybe half of your investable assets in syndications that are garnering an average of 8%, whereas you still do the traditional stuff where you can maybe assume that it's a 4% withdrawal rate if you want to take money out of the stock market. So then all of a sudden that timeline to get to that 2.5 million, now you could maybe, when you do the combination approach, get to that same place with 1.5 million, roughly. So it sort of truncates the time frame to financial independence. And so if someone's goal is 10,000 a month passive income, then if we have a calculator within our sheet that sort of opens people's eyes to this ability to attain financial independence, to where one example that we default to in that particular sheet is that if somebody invested 100,000 annually, so depending on the 50,000 minimum or 25, whether it's 2 to 4 deals on an annual basis, and assuming reinvestment of any of the proceeds, assuming an 8% return, assuming a 2% inflation rate, if you needed to reach that 120,000 a year or 10,000 a month of passive income through syndications only with that 100,000 a year investment, you could get there in 7 to 8 years.
Wow.
So instead of spending it, and that's not even taking into consideration the stock market. So instead of spending 25-year career on saving 2.5 million or something in that, or even 15 years, you could get there in 7 to 8 years on syndications alone, but you have to invest 100 grand a year.
Right.
So to me, when you combine the syndication investing with the traditional investing, it's just so powerful at how quickly you could do that. Even if somebody doesn't want to retire, even if they want to cut down to 4 days a week, you may not need that full 10,000. You may only need 4,000 a month to sort of offset that one day, or 5,000 a month or something like that. So yeah, I think that the cool thing about syndications is it really gets to sort of truncate down that process that it would take you to get there.
Yeah, and that's a really valid point, and I love that two-prong approach. Yeah, because the returns that we typically project and see in real estate syndications, I mean, I couldn't sell an 8% return to investors over the life of the deal if I tried. I mean, because it's just too low. Like I won't invest in that. Like I don't want 8%. I want 12 to 15. Like that's
of course,
that's where I need to be in order for me to put money in. So, and that just obviously accelerates it even further. Not that you're always going to get that, but that at least is, the types of opportunities we look at. So to even further your point, it's like 8% is really low in a real estate deal. So,
and that's just being conservative, but you're right. You say a deal does perform like what we're looking at in the traditional IRRs lately, like in that 12 to 14 or 14 to 16. Then all of a sudden that 7 years goes down to 6 years or 5 years. So it's really, it can be amazing. And you want to take conservative assumptions when you do these kind of planning. But yeah, if things sort of continue as they were, then you could even truncate that even more.
That's fantastic. I love that. When you talk to the people that are coming on, I think you said residents or people coming in, and you kind of give them, because I know that you are asked to speak about financial topics. What are some of the things initially? Because you can't just fire hose people with, hey, real estate, IRRs, all this stuff. Like, what are some of the more basic things you start with?
Yeah. So basically, the way that I sort of outline it is in the physician world, like the big thing for physicians in particular in training is like the student loan burden. So it used to be, when I came out, it used to be $100,000 in student loans was a lot. But now, unfortunately, in talking to a lot of residents and fellows, it's not uncommon for them to have 250 to 400,000 in student loans coming out, especially if it's like a 2-physician couple. So this kind of burden is almost like a second mortgage payment. So when I teach personal finance to these residents and fellows, I always start with the debt piece. So I go over debt in more detail and what the plan is to attack the debt. Whether, in terms of whether it's credit card debt, whether it's just student loan debt, whether it's other debt that they have, personal debt, and how to attack the debt piece first. And then I sort of go into the insurance metrics and, things you want to cover yourself from insurance for cover for catastrophe, whether it's life insurance, disability insurance, umbrella insurance at some point in time. So those are sort of the foundations of you got to get through that first. And then we sort of transition into, what do I want to invest in? Even though I believe in real estate, I usually do start with, equities investing and stock investing. And I would say the point of physicians I would say at least 5 to 7 years out is when they would start to think about these alternatives that we're talking about. So it's not someone that is probably going to invest in this kind of thing right off the bat. They kind of have to get that foundation, build it up, have some disposable assets. Then they can transition, once that's all set in place, to these more sort of alternative investments.
How do you feel when talking about the debt piece? I don't know what student loans are interest, what they're charged on interest now, but it's got to be sub 3%. No?
For some of them, believe it or not, there are some that are still in that 5 to 6% range. So the tricky part is, in the physician world, there's something called like public service loan forgiveness, or PSLF. Right. That is a federal program that allows you, if you work in an underserved community or you work for a 501c charitable organization, which a lot of hospitals are, right, for a period of 10 years in total, those full amount of loans can be forgiven if you're paying what's called an income-based repayment plan. So if you're paying a certain percentage based on what your income is, then that can be forgiven. So in someone like me, for example, if I'm a gastroenterologist, that requires 4 years of med school, 3 years of residency in internal medicine, assuming the 4 years of college, then 4 years of med school, 3 years of residency, 3 years of fellowship. So
14
just the
years.
medical training is 10 years.
10. Okay. Bad math. Early morning.
So then if you start that public service loan forgiveness or the income-based repayment in the 3 of residency and the 3 of fellowship, you only need to work as an attending or a full-fledged physician for 4 more years to get those loans forgiven.
Wow.
So what people often don't know is if they consolidate those federal loans to a private loan, they disqualify themselves for being eligible for that.
Oh, geez.
So some of these people they may have a 6% loan, but they're consolidating to something lower. But they could, and they're like, oh, great, I got a 3% loan now. But then they could have gotten forgiven if they worked 3 or 4 years and they didn't even realize it. So there's a lot of misinformation out there, and where physicians aren't aware of all the implications depending on the type of loans you have.
Right. Right. That's intriguing. I guess the follow-up question to that would be, if inflation is, what it is now, it's 6-7% ish.
Yeah.
Do you change any of that if someone has a 3% loan and say, hey, you know what, maybe we won't pay that debt down as fast? Or is it one of those things where you just find getting that out of the way is just helpful to do?
Yeah. So if they qualify for that public service loan forgiveness, then I would still stick with the income-based repayment plan, and then where you can maybe get it forgiven completely. Because say you start with 300 grand and you're paying the income base, because the residents and fellows only make about 50 or 60 grand a year. So if you're maybe paying like 500 a month, then you may as well do that for the 6 years. But your net of what you're bringing down on that 300 grand, you may still owe 270 grand when taking into consideration the interest rate.
Right.
So if you can then forgive that over 4 years, it's still, I think, a smart move to do that. But in someone who doesn't qualify for that PSLF and just has a fairly low interest rate and they're just going to be paying it, then if you think you can manage that delta between the 3% and what you can make on your investments, whether it's through equities or real estate or whatever else it is, then yeah, I wouldn't rush into paying those off unless from a mentality standpoint or there's some mental benefit to paying it off. But financially, if you can make that delta and the difference between the 3% and whatever you can make in investments, then there's no reason to pay that off any quicker. I agree with you.
Right. Yeah, that's interesting. It is. I mean, for me personally, I don't have any debt on my primary residence, and it doesn't make financial sense, right? Like interest rates are so low, but it's a nice little warm blanket that I put on. I'm like, oh, I don't owe anybody anything for my house. So
yeah,
it's kind of like,
yeah.
And that's a personal decision more than it is a business one. But I just wondered how you coach people on that, when they come in, like, okay, here's my debt piece, because that's what you start with. What that looks like. So thanks for breaking that down. Sam, this has been a ton of fun. Thanks for taking the time to come on the show today. It sounds like you got one more thing here you'd love to share with us before we jump into the final 4.
Yeah. So what I was saying is you see a wide variety of people's views on that mortgage component. Like what you said, it feels good just to be able to know, like, I have a place to live. I don't have to worry about mortgage payments. And the other thing, depending on the size of your mortgage, it can free up a good amount of cash flow, which then you can earmark for other things and you don't have to worry about that. But then you get the opposite end of the spectrum where you hear, and a lot of people in the real estate community, not to say it's the wrong thing, but it's just interesting, the differences, where some people say take out a home equity line and on your house where the interest rates are, and then use the home equity line to invest in syndications. Which I'm not quite to the point where my home is paid off, but I definitely have some equity. And I've thought about it, but I'm not at the mental space where I can just take some of that money and take it out of my house to put it in some syndication. So it's an interesting spectrum.
It is, and it's more of a personal just comfort decision more than it is just a strictly numbers, dollars and cents decision. So that's interesting. Was just curious what you had on that. Sam, the final 4 questions are this: what is one tool or resource you find you can't live without?
So I guess I would say my tool on the passiveadvantage.com site is one that I couldn't live without. But I think separate from that, I would say that the ability to be a detailed person in terms of what I need to do to educate myself has allowed me to get where I am everywhere in terms of everything, whether it's in my medical profession, in my real estate investing world. I think it's important to take your education very seriously, focus on it, spend the appropriate time, and then be detailed at what you do with that. And that's probably something that personally, I'm not sure if that's sort of allowed in terms of the way to answer it, but personally, it's most important to me from that standpoint.
It's your answer. I love it. Question number 2 is this: what is one mistake you can help us avoid, and how would you avoid it?
Yeah, so I think getting back to the student loans, I would say if you are a physician listening to this podcast, or you have student loans, even if you're not a physician, look into the PSLF program and make sure that you're not consolidating your loans before that would disqualify you from starting with that. Because if you can wipe off 300,000-400,000 in loans, and you're making it's a big mistake I've seen a couple fellows make before I've had the ability to educate them. It's something worth looking into if you have a lot of student loans and you may be working for a nonprofit down the road.
Right, man, that's fantastic. Question number 3, when it comes to investing in the world, what's one thing you're doing right now to make the world a better place?
I think the biggest thing, and it comes back to the point 1, is educating. I think I'm a big believer in, like, we get what we give, and whether it's through charitable donations which my wife and I do through our donor advised fund, or whether it's through educating others. I think it's my passion to help people, whether it's, some of our fellows and residents that we do at a personal level in the personal finance space, or just helping guide them in their life decisions, or whether it's helping other passive investors invest in real estate syndications, maybe alert them to some common risk points or deal points. I think giving back through education is one of the biggest things that I try to impart as a way to help.
That's fantastic. Sam, if our listeners want to get in touch with you or learn more about you, what is the best way to do that?
So you can reach me through our website at www.passiveadvantage.com, or you can email me personally at sam@passiveadvantage.com, and I'm happy to help any way I can.
Sam, thanks for your time today. Appreciate you coming on the show.
Oh, it's my pleasure, Sam. Thanks so much for having me. It's been a great time.